I don't normally reveal what I do here on YouTube, but this time I'm gonna make an exception and I'm gonna tell you guys about a growth stock that I recently have a position in. I opened a position. I don't believe anyone is kind of too late on the stock. I still believe the upside potential is massive. So I do have some kind of a position on it, which I'm gonna reveal at the end of the video. Rapid growth company. Most of you guys kind of heard of the name. You've been asking me to do a video on it, and I haven't been doing a video on it. So I'm gonna do this video now, let you know my opinion. Amazing stuff. So I hope you don't let the price action influence you, and I hope you'll watch the entire video and then try to consider this company. So I really hope you enjoy it as always. Now this stock is OSCR, which is OSCR Health. Now most investors would look at this chart, they would say, oh, it's up 12% over the last months, it's up 60.5% on a day, I'm too late. Now if you guys really believe you're late, I don't know what to say, because if you watch this video, the stock has $40 to $50 potential upside. So if you're buying it at 19 instead of 17, does it really matter? Like, it's the same thing when I talked about HIMS at $10. It went to $12. They say, oh, I'm late to the party. I'm like, just forget the price. Look at the fundamentals. Look at if this is actually sustainable or not. Like, I don't really sometimes understand how most, retail investors think. I'm not saying FOMO, but I'm saying don't let the price action influence you and try to look at the fundamentals, which is ultimately what really matters. Now, OSCR is going to be a little bit hard to explain, but it's mainly some kind of an insurance company that's disrupting traditional insurance companies, mostly for the employer-employee kind of relationship. It's something very different, and it's called ICHRA versus a traditional group like United Health and Aetna and other kind of insurance companies. It's a massive difference. And OSCR isn't exposed to Medicare, they're exposed to ICHRA, which is mainly on its own, and it's been gaining a lot of market share recently. Now, the advantages of ICHRA versus a traditional group is budget control. So with this one, the employer gets to choose a cap on a specific budget that he contributes to the premium, and they contribute to everything else. And it says employers set a fixed budget for contribution, reimbursing employees tax-free for individual health insurance premiums and eligible medical expenses. This allows employers to cap cost and avoid unpredictable premium increases common with traditional plans. Now, the traditional plans, employers typically pay a significant portion of premiums, 50 to 80%, which can fluctuate based on group claims, employees, demographic, and market rates, making budget less predictable. So this is really good for the employers in terms of the budget, but it's also good for the employees. But for the employer, it only needs 10 minutes to set it up. For a traditional insurance plan, it takes 30 hours, and sometimes you need someone on your board or on your team that specifies in insurance for them to be able to even understand how to set up the whole thing. It's very complicated. With OSCR and ICHRA, it takes less than 10 minutes. Now, with this one, any kind of employee, any amount of employees can participate in the insurance plan. Normally here in the United States, let's say you have a small business, you have a few employees, you normally don't have an insurance plan, because the less people you have, the more expensive insurance is going to be, the more people you can get in, the cheaper the insurance is going to be, which leaves a lot of small businesses unable to give their employees access to decent insurance. And that's what happens in the United States. But with ICHRA, any kind of numbers of employees can participate in this insurance plan. Versus a traditional group, you need 60% of the employees. And normally, I would say at least, I think 60 or 80, depends on how many, but you need a lot of employees. You can't just do it with one or two. It's very difficult, and it would be very expensive. Now, for the employees get to pick their own plans. This is not available with traditional companies where you have the same plan for everyone, and you either want this plan or you don't want this plan. You can't choose the plan that fits you best, that fits your own needs, your own benefits, your own care activity. You can't do that. You have to choose whatever your employer has chosen for you. But with ICHRA, you have the choice to choose your own plan that fits your need best. And this is a game changer. Last one, for employee value, they see contribution. With the other one, they see paycheck deductions. The whole thing is different. And this one is much cheaper, which I'm going to show you guys. But in terms of the reviews, And this is something that's important because most insurance companies in the United States are hated. And this is based on a Forbes kind of survey. And the most hated one, which is I own also, is United Health at 2.67. If you're below 1, that means you're not as hated. OSCR is number 3 at 0.51. So it kind of has a good reputation. You're still gonna see some hate, of course, that's how it is, but it's not as hated as other insurance companies. Now, if we compare the prices of OSCR Health versus Aetna, Blue Cross Blue Shield, and United Health, all of those are very big. At age 21, OSCR is 410, Aetna is 486, Blue Cross Blue Shield 479, UNH 455, and even at age 60, 1,112 versus 1321, 1301, 1235. So if you look at any age group, OSCR Health is much cheaper than Aetna, Blue Cross Blue Shield, United Health, and most insurance companies. And you also get to pick your own plan, and it's much more efficient and it's much cheaper. So this is pretty amazing. And that's why the company has been growing in members from 400,000 members to 2 million members, 2 million. Here in the United States. And by the way, I'm using FinChat to come up with my chart. So if you want to try it out, you get 2 weeks of free access if you use my link in the description. Now we look at total revenue growth. Total revenue, 69% CAGR, 400 million to 11.2 billion. This is insane kind of growth for a company like OSCR. Now I showed you the growth. The members have been growing 51% CAGR. Revenue at 11 billion has been growing 69% also, 69%. Now, what kind of multiple would you normally assume OSCR is trading at? Maybe 1 time sales or 5 times sales, 10 times sales? It's not even at 1 time sales. OSCR is trading at 0.2 times sales, enterprise value to sales. And I'm using enterprise value because they have such a big cash position. So it's really cheap, unusually cheap for a growth company like OSCR. Now, one of the reasons why it has been cheap is because the company has been unprofitable, there has been some dilution, and they have been losing money, but they have recently turned profitable, and they believe this profitability is going to be sustainable. Now, I'm waiting to see if it will be sustainable, so it's a little bit of a gamble, but it's been massively improving. If you look at their net profit margins, they were negative 20%. Now they're only 1.2%. Now, normally amongst healthcare kind of stocks and insurance stocks, the net income margins are between 10 to 15%. So at 1.2%, OSCR could still 10x their profit margins, and earnings per share could go up like crazy, and it wouldn't be a big challenge for them to grow at such rates. Now, for analyst estimates, 2025, OSCR is expected to grow earnings per share 582%. It might sound crazy, but again, this is because they're just turning profitable, so you have crazy kind of estimates. But 582% at 68 cents per share, it would put OSCR at 27 times earnings. This is not expensive at all. 2026 is expected to be 74% growth or 15 times earnings. 2027 is expected to be 65% growth or 9.5 times 2027 earnings. This is really cheap, guys, for a growth stock, and you really don't see it very often. Now, this is actually still conservative versus the company's own estimates because the company is expecting 20% CAGR in revenue growth. They're expecting 5% operating margin, and they're expecting earnings per share of $2.25 by 2027, not $1.96. They're expecting $2.25 by 2027. Now, if I just do a quick calculation to show you guys why you're not late if it does play out, and we take in 225 and I time it by 25 times earnings, which I believe is fair for a company that's growing at this scale. It's only 4 billion market cap, so it still has a lot of potential with market cap, potential with net income margin. Using 25 times, this is $56.25 per share. The stock right now is trading at $18 per share. This is more than 212% on the upside. Over the next 2 years, 2.5 years with a company like OSCR, if it does play out, and you can use 20 times earnings, it's still like 150% in 2 years. I mean, it's really insane kind of upside if OSCR does play out. Now, OSCR does have a lot of risks, which I have to mention. This is why it's a big gamble. The first one is, of course, them being able to be consistently profitable on an earnings per share basis, or in terms of profits in general, they just turned profitable. Net income margins have just turned positive. So it's still very speculative in terms of the company being able to consistently be profitable. But there is a few more risks. One of those risks is mainly the subsidies. So the company also relies on certain subsidies for them to have lower insurance premiums for lower income kind of people. So if you make $23,000 in the United States and you do have an ICHRA plan with your employer, you pay $0 in premium every month if you have the subsidies. If there's no subsidies, you pay $75. It's still not a lot, but it would make a difference. Okay. Now, $38,000, you pay $122 with no subsidies. You gotta pay $253. So it will increase the cost of employees' insurance and employers also, and that would make OSCR a little bit less competitive than what it would be. So it would affect them, of course, if the subsidies they expire, and they do expire at the end of this year of 2025, which is another reason why the stock is cheap. But even if you remove the subsidies, OSCR is still likely much cheaper and much more efficient for employers than traditional insurance because of the things I highlighted in the beginning in terms of them just being much more efficient. It's much faster to implement, and it's still a better way for employers to cap their cost. But if you look at their TAM, how it would affect them, they expect by 2027, without the subsidies, they can reach 24 million people. With the subsidies, could be up to 31 million people. So I'm not sure if they're going to let it expire or they're going to renew it by the end of 2025. It's up to Congress. But if I had to guess, I would guess they will most likely renew it going into an election year in 2027. I don't know. I highly doubt they're not going to renew it. But, you know, it's I should say in 2026, but it's very, very possible. But if we look at OSCR's own expectations, even without the subsidies, which would take into consideration a 5 to 7% impact on total growth, they would still expect to grow 20% CAGR. So in other words, even if the subsidies are not renewed, OSCR will still grow 20% CAGR from now to 2027. So the subsidies are very important. I think it's more like OSCR will likely do very well without the subsidies. But if they do get renewed, it's going to be like a call option where the stock just skyrockets like crazy, because then they have a much larger TAM and they have much more growth. But even taking into impact of the subsidy expiration, they still expect 22% CAGR, and this 225's earnings per share that I showed you guys is expected based on the subsidies is expiring. But if they are extended, then they see upside if enhanced subsidies are extended. So it's without the subsidies. So again, we're valuing it with no subsidies, and there's a lot of call options here with the stock. Now, for my own position in OSCR, I have the June 2026 $25 calls on OSCR. I bought call options. They're up 65% in the last 2 days. I might potentially buy stock myself and hold them for the long term, but I did buy some options. But the way I think about OSCR, and I think about even buying the stock in general, is still very speculative. Like most growth stocks in their early stages of profitability, they are speculative. But the way I think about them is, okay, I put in a small percentage of my portfolio in OSCR and HIMS and any of the stock early on. Like when I bought HIMS in 2023, it was unprofitable. It was a small position. I said, okay, if I'm right and the company becomes something, then my upside is unlimited. But if I'm wrong, then my downside is limited. So if you limit your downside, your upside with those stocks, it's an asymmetrical payoff where your upside is insane, but your downside is limited. So there could be potential losses. I told members, if you want to buy OSCR, be ready to potentially lose 30 to 50% of your money. So we're not going to put in a lot in it. If it works out, it goes up 10, 15, 20 times, then we make a lot of money. If we don't, then we take a small loss and move on. And that's how I think about the growth stocks in general. Now, if you want to learn options and learn how to trade options, I have an options course all within my own subscription. And I tell you exactly when I buy something, when I sell options, all in real time. Most people don't do that. And this is the link if you're interested. But thank you very much for watching. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.